The Nifty is down about 130 points, 123.
Markets started slipping a tad bit as we speak, so we're down about 100 points on the Nifty, which closed lower, massively lower, is down just 10 points as we speak.
The market is absolutely fine. In fact, the SGX Nifty was down 200 points. The market opened lower but respected the SGX Nifty low, respected. The price action in our market has been very strong, and consistently the market's been defending the 20-day exponential moving average. The day it violates that, perhaps that trade is nullified, but till then it remains a buy on dips market.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Sensex and Nifty end with marginal losses as banks and auto stocks declined. Midcaps outperformed the blue chips once again. Rupee weakens against the dollar but remains just below the 80 mark. Container Corp rallies 8% after sources say that the cabinet has approved the reduction of railway land license fee from an earlier 6% to 1.5%. Cement stocks surge. Shree Cement and Ultratech Cement rally between 3 to 6%. This comes ahead of Adani Group's open offer. Meanwhile, Birla Corp tells CNBC-TV18 demand is strong. Expect volume growth of 15% in FY23. Auto major M&M says the SUV demand is very strong and they have gained market share in the SUV segment. M&M is now the second largest player by volume in the SUV segment with 17% share. Biocon soars 3% after it says that it's not looking to sell further stake in Syngene. Nifty Pharma gains over 1% after sources say that the promoters are evaluating options to sell majority stake in the company. Well, here's the lineup of what we have in store for you today. It's a packed show. In market opinion, we have Krishna Kumar Karwa, MD of MK Global, and in corporate opinion, we have Rajesh Jejurikar of Mahindra & Mahindra. Well, let's start as always with the day's market action. A range-bound session on the Lal Street ended with marginal losses for the Sensex and the Nifty. Bank stocks led the decline, along with auto stocks and midcaps managed to buck the trend for the second day running. And Single is here with the day's trading action. Anuj.
Well, the Indian market was down but not out, and it's a market which has been very resilient, been the best performing market globally among the big markets. Today also there were a lot of negative cues like the dollar index, what happened to US market, bond yields. Market just ignored all of that. And once again, the key point, the 20-day exponential moving average was once again held today. The Nifty tested it in the morning and then had a very sharp 150-point recovery, more than that actually at one point. So that tells you that the market is strong. In terms of individual stocks, auto stocks did see some profit taking today. So names like Tata Motors, Bajaj, and Maruti, Mahindra and Mahindra were all down. There was some profit taking in some heavyweights like SBI, ICICI Bank, Reliance, and HDFC Bank as well. On the gaining side, cement clearly was the sector of the day. Shree Cement led the move with 7% rally. Big one, Ultratech Cement as well, was up 4.5%. That's the pocket which did well. And a couple of these IT names also managed to bounce back. In the broader market, there were some big gains in names like Concord, Vodafone Idea, Z Entertainment, and then, a couple of others like Astral, etc. also did well. All in all, broader market continues to show strength.
Oh yes, broader markets, they have been an outperformer. Anuj, thank you so much for joining us with those details. Here's some expert market opinion for you now. Krishna Kumar Karwa, who's the managing director at MK Global, said that there was scope for broader markets to do well. On the cement space, he said that it's better to stick to the larger names. Listen in.
Whenever retail participation increases, you're bound to see the breadth of the market increasing and maybe some of the small cap and micro cap names also outperforming. But if you look at it from a one-year perspective, the small cap indices are still underperforming the large cap indices. So there is still scope for the broad market to do well. But I think what is happening is that there are so many micro sectors where you see tailwinds coming in, and maybe the first rush, some of these stocks move up and then consolidate, and investors understand the story, and then there is a second round and third round of movement. So some of the sectors like capital goods or EPC companies, etc., or even microfinance business. So I think that is a sector which is going through consolidation and will continue to consolidate. I think it is better to stick to the larger names in that sector, and maybe some of these large mid-cap companies which have all India presence and ability to be participating in the consolidation. And yes, I think second half of the year is expected to do much better for these companies as input pressures, etc., come off, and realizations also inch up.
In fact, let's get in some more market opinion now. Cameron Brand, the Director of Research at EPFR Global, said that there have been steady flows to Indian funds. He added that India will see stable interest from fund managers. Take a look.
There have been steady, if not spectacular, flows into dedicated India funds. And India funds have been really second in the emerging markets universe after China in terms of attracting fresh money. And so certainly, I continue to think that that's a likely trend. As I'm sure you're aware, many of the forecasts in the developed world, especially Europe, for the end of the year into next, make somewhat gloomy reading. So a large market with a strong domestic demand story and the promise of 7% growth is very attractive at the moment. I don't see much competition at the moment from any of what you might call the second-tier markets. And I think until those waypoints in Brazil and China are passed, that India is likely to see pretty steady interest from the gem fund managers.
Well, that's about the equity markets in some opinion. Now over to the money market. The Indian rupee weakened marginally against the US dollar. The rupee has been declining for the last few days but is yet to breach the 80 mark against the greenback yet. All major currencies are declining against the dollar, which has been gathering strength over the last few weeks. With that, we move on to the second headline now. Container Corp ended the day over 8% higher after we learned from sources that the cabinet has approved the reduction of railway land license fee from an earlier 6% to 1.5%. Sapna Das is here with all those details. Sapna, what does this mean more for the sector? And there is a clarification here as well.
Well, government has certainly reduced the land license fee for leasing of railway land, in the amendments to the policy basically, and the revised rate now stands at 1.5% of the land value against the 6% that is there for the existing players. However, an important clarification here would be that all the new rates or the amended rates apply only for the new players. The existing players will continue to pay the 6% of the land value as the LLF, and their annual escalation rate also stays at 7%. However, they are being given the option of switching to the new regime, wherein 1.5% will be the LLF and the annual escalation rate is going to be 6%. So that needs to be kept in mind. Clearly, this was a strong demand that had come in from various sections of the society, or rather a lot of feedback had come to the government that this land license fee should be reduced. In fact, Nifty Auto at one point in time had recommended that the LLF should not be more than 3%. So there was a bit of resistance also from the railways at that point in time, because nobody would like to lose revenue, so to speak. However, this new policy now rolls out in 90 odd days. That's what we are given to understand. Railways is likely to notify this in 90 days, and post that, government will be able to move forward on its Concord strategic disinvestment.
Sapna, thank you so much for joining us with those important details. A very important story coming in from Container Corp. To the third headline now, cement stocks cemented gains with stocks like Shree Cement, Ultratech and ACC gaining between 3 and 8%. This comes ahead of the Adani Group's open offer. In fact, we have Nigel with us who's telling us what's really brewing in the cement sector. Nigel.
Well, that's right. Let's break it up into two parts. The larger names then. ACC and Ambuja, remember all through this year, they have done a relative outperformance. But otherwise, the traditional, traditional stocks that find favor with the market have been Ultratech as well as Shree Cement. Both of them have been relative underperformers. So for ACC and Ambuja, it seems that the street is now baking in. A new, more aggressive promoter comes in there. That's the Adani Group. And that's why, they'll be more aggressive in the market. Remember, they've been losing market share. So that's about ACC as well as Ambuja Cements. Actually, the stock prices performance in 2022 should come up for you. For Shree as well as Ultratech Cement, it appears that they have underperformed by around, 10 to around 15% lower in this year itself. So they've underperformed the other two, and they are playing a bit of catch up. So that's why those stocks are running along. In fact, for Shree Cement, which has been a rank underperformer, it was, out of the Nifty. It's all that announcement has come about. In the run-up to that announcement, we did see a lot of selling. So that's playing a bit of catch-up out there. Now, on a valuation parameter, Ambuja Cements, that's relatively more expensive in comparison to ACC. But keep in mind, any kind of expansion is likely to come about from Ambuja Cements. And Ambuja Cements' profitability is better than ACC. The problem for ACC, what the street understands, is that they have a bit of a limestone issue. Ultratech as well as Shree Cement, they've always traded at higher multiples in comparison to this group, and that's still the case. Now, 5 big reasons why, in fact, the street is getting optimistic on the cement industry. One is cement prices have been increased across the board, all across the country, north, east, in parts of south as well. I understand that in south it could be a little difficult to push it through, but in north as well as east, it's likely to get pulled through. And Birla Corp management, they indicated that demand is strong enough to absorb that. Pet coke prices are down by close to 25% domestically. International prices, pet coke prices are down far more. So that could result in 200 to 300 rupees per ton saving for Q3 FY23. So the street is baking in that Q2 FY23, it could be basing out or bottoming out of margins, and they could see a recovery from here as volumes pick up, pricing picks up, and input costs cools off. Post-monsoon, we know demand bounces back, so that's likely to play its role as well. Strong demand in the second half of the year is what the street is factoring in, and hopes of some bit of consolidation that could potentially play out. That's where you're seeing some of these smaller names, potential targets, so to call it, whether it's Sanghi Industries, India Cements. The street believes that there is something going on out there. We don't have any confirmation, but those stocks just in the last 1 month have seen a big run. Back to you guys.
Oh yes, massive buying in the cement space. In fact, we caught up with Rajesh Ravi of HDFC Securities earlier today, and he said that he preferred ACC versus Ambuja Cements owing to valuation comfort. Meanwhile, Aditya Saragi of Birla Corp believes that demand will support the recent price hike affected by them. Listen in.
Among the two stocks, ACC and Ambuja, the valuation is much comfortable in case of ACC, while Ambuja on a standalone basis is trading north of $180, $190. So we obviously believe that ACC has more valuation comfort as a standalone entity. The stock is trading at less than $110, $120 today, at $120 per ton. So we find ACC to be more comfortable and more. We find there is more upside in case of ACC versus Ambuja.
The price fall would vary from region to region, but my sense is it will be in the range of 150 to 250 rupees per ton. We have recently increased price in the eastern and the western regions to the tune of 15 to 20 rupees.
Okay, and it's time for a break now, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're still with us on Markets Today. Let's go to the rest of the headlines that we are tracking for you. To the fourth headline now. Auto major M&M says SUV demand is very strong and they've gained market share in the SUV segment. M&M is now the second largest player by volume in the SUV segment with 17% share. Rajesh Jejurikar, the Executive Director, Auto and Farm Sectors at Mahindra & Mahindra, said government spending on rural India is improving. He added the industry may see a growth of 3 to 5%. Listen in.
This government spending in rural India, which had been very slow for the first 4 months or so, has started kicking in. So we are seeing cash flows improve in rural India on account of that. Thirdly, the prices in the mandi are higher than they have been in the past. And we have been in the last few months talking about a negative terms of trade for the farmer. And we see that reversing as well. Our view at this point of time is remains the same, similar to what we had a month back, which was 3 to 5% growth for the industry. Depending on how the festival season actually pans out, we may take a fresh look at that growth estimate sometime in the month of end of October after the festival season, early November. So we'll wait to see how that happens. But right now, there are several positive indicators. In November, we are planning to put out a capacity ramp up that we will, execute over the next 12 to 18 months. That would give a stronger perspective on how we're adding capacities on the SUV side. Clearly, we are using all our capacities on the SUV side. We have a very large waiting period, and we're doing everything possible to bring that down. Measure volume market share, which is the SIAM definition, where we get about 50% market share this year. We are the number 2 player by volume in the SUV segment now, where we.
That's not all with the auto sector. In fact, Bajaj Auto was down by over 2% in trade today after CICICI cut target price. Sonia Shenoy is here with the details on that brokerage note. Sonia.
thanks a lot for that. If you remember, when the numbers came out for the two-wheeler sector, we had highlighted that the big takeaway is a fall in exports. CLSA today downgraded Bajaj Auto to an outperform. They lowered their target price by 8% to 4343 rupees. They do mention the same reason, that there is a big fall that we've seen in exports, and most African markets are very challenging at the moment because of a dollar shortage there. Remember, 60% of Bajaj Auto's volumes, export volumes, comes from the African market. Nigeria has also seen a restriction on two-wheeler movement, and because of this, CLSA forecasts a 16% decline in the motorcycle exports for FY23. But Bajaj is not alone. All its peers have also seen a big slide in exports. TVS exports were down about 15%, while Hero MotoCorp, which has a smaller portion, exports were down almost 50% year-on-year. Back to you.
Okay, that is all about what's happening with Bajaj Auto, and Sonia was here with those details. But moving on to another auto news now, Hyundai has seen a strong and stable demand. The company director of sales, Tarun Garg, said the company saw a surge in their SUV segment. Listen in.
Auto industry in India is a prime example of this resilience, because globally when we see, inflation, interest rates, some kind of talk about big terms like stagflation and all, and we are seeing a pretty stable and strong demand in the auto sector. And as far as Hyundai is concerned, of course, festival season is looking quite good. 53% of our sales is coming from SUVs. Onam as well as Ganesh has started on a very stable note, and now we enter, of course, the Navratras and Dussehra and Diwali. So things are looking up. If I talk about, say, 2015, SUVs used to contribute 13.5 to the overall industry. And today already they are contributing 41%. So just see, in 6-7 years, 13.5 has become 41. That is first point. Second is hatches used to contribute 50%, and hatches are now 34-35%. So SUVs has emerged as the biggest segment. So very clearly a huge growth in SUVs is happening.
Okay, that is a 360-degree view on the auto space. Moving on to the fifth headline today, and it's all about pharma names. Biocon ended the day over 3% higher after Biocon sold 5.4% stake in Syngene for 1220 crore rupees. Ekta is here with details on the deal. Ekta.
Well, yes, Biocon and Syngene have been in focus in the past couple of days. Biocon has sold stake in Syngene. They've sold around 5.4% stake, raising over around 1,200 odd crores, which would be equal to around $150 million. Now, why exactly is Biocon selling stake in Syngene? That is to fund that equity component of the Viatris deal. Remember that they struck a deal to buy out a biologics business from Viatris earlier this year for around $3.3 billion. Now, $2 billion, which will be basically given on the closing of this deal, which is expected in this fiscal, comprises of around $800 million in terms of equity and $1.2 billion in terms of debt. Of this $800 million, Biocon has a commitment of around $250 million, and out of this, $150 million is now raised via the stake sale in Syngene. Now, Biocon did speak to us earlier in the day. A couple of important takeaways is that they are now not looking to sell additional stake in Syngene. They do have a 90-day lock-in with the promoter, so they will not be able to sell further stake in Syngene for 90 days. Multiple fundraising conversations are underway for that additional equity component which is required. They are in fact seeing strong demand when it comes to equity infusion in Biocon Biologics, and Serum, which already holds stake in Biocon Biologics, could probably put in an additional $300 million and could eventually hold 12 to 13% on a diluted basis. The debt to equity component, which is $800 million of equity, $1.2 billion in terms of debt, could probably be reworked with a higher equity component. We'll get to know all of these details in the next couple of days and weeks.
Biocon Limited, which is a parent of Biocon Biologics, has to pump in minimum $235 million contractually. And to part fund this investment, we have raised $150 million by divesting roughly 5.5% in Syngene. And now with this sale of Syngene, we do not expect to divest any more shares in Syngene. And we also have a committed to a 90 days lock-in to the investors who have invested in this block trade.
Well, that was all about Biocon. Let's continue with the pharma coverage. Suven Pharma was up over 1% in trade today. This is on the back of a large deal brewing in the pharma sector. Sources suggest that Suven Pharma is on the block. Nisha Pudar gets us those exclusive details. Nisha.
That's right. There's a large deal brewing in the pharma space is what we gather. In fact, 3 independent sources with direct knowledge of the development have shared with us that Suven Pharma could be on the block. In fact, the promoters are evaluating the options of selling a majority stake in Suven Pharma is what we gather. And for that to really, the process to go on, they have even hired an investment bank for the sale process and a control deal in Suven Pharma. We do gather that some of the private equity players who have been quite bullish on the pharma space and want a larger buyout opportunity are in talks with Suven Group for this particular opportunity. There could be some strategics also in the fray for the deal talks. Now, looking at the group, remember that Suven Life Sciences had demerged Suven Pharma as a separately listed company in 2020. And after that, the dividends that were being generated by the cash-generating Suven Pharma were used by the promoters to infuse capital into the cash-guzzling Suven Life Sciences business. Now, the promoters feel that probably it's best to monetize the pharma business, raise a lot of capital so that they can focus on the drug development business of life sciences. And that's where this particular deal talk has really emerged. In fact, we reached out to the company and they did not respond on the deal talks to sell Suven Pharma. But on the other hand, did share that they had announced a rights issue to raise funds in Suven Life Sciences earlier this year.
Nisha, thank you so much for joining us with all those details. And before we wrap now, the Murugappa Group has re-entered the electric vehicle business. The Chennai-based conglomerate launched its electric scooters in 2008, but it has no plans to make two-wheelers for now. Murugappa Group company, the Tube Investments of India, has launched an electric three-wheeler under the brand Mantra Electric. Speaking exclusively to CNBC-TV18's Jude Sanith, Arun Murugappan said the two-wheeler market is crowded and the company will focus on three-wheelers. It is also planning to launch an electric truck and a tractor.
2008 it was where we went to electric scooters, and I think we were a little too early for the market itself. Yeah, and coming to it now after so many years, I mean, electric is the way forward, and we intend to go we formed this platform called TI Clean Mobility, and we probably have different platforms, starting with the three-wheeler, the tractor, and then the truck. The initial outlay, we've put about 200 crores in this project, and our capacity today is about 75,000 units per year. Yeah? And any further capacity when the time comes, we will invest and then go forward from there.
Okay, that is about the Murugappa Group plans in the EV space. With that, it's a wrap on this edition of Markets Today. Thank you for watching.